Well, we're seeing the real cost of no-fee stock trades as a result of the Wall Street Bets rally last week, followed by this week's drop in meme stocks. Not only do traders sit on deep losses right now, Robinhood's addictive platform faces scrutiny for gamifying stock trading and vetting rookie investors. The app's monthly options trading volume surged 197% during 2020, and Google also saw a jump in searches of, quote, how to trade options on Robinhood. In the past 10 days, an average of 1.1 million GameStop option contracts traded daily, more than 22 times what was typical in 2020. Concerns about Robinhood's screening of investors arose last summer after the suicide of a 20-year-old college student. His family says it happened after he saw a negative $700,000 balance on his Robinhood account. That figure turned out to be misleading. All the while, Robinhood's co-founder says the app is meant to embolden novel traders, even if that means restricting trades. This morning, Treasury Secretary Janet Yellen discussed an upcoming meeting on market regulation with Good Morning America.
We need to understand deeply what happened before we go to action, but certainly we're looking carefully at these events. We really need to make sure that our financial markets are functioning properly, efficiently, and that investors are protected.
With me now is Bloomberg Markets reporter Sarah Ponsick. Hey, Sarah, good morning. Robinhood has put out just a ton of fires recently, but last week things really went to another level. Taking a step back, the 30,000-foot approach, what is Robinhood and what are Wall Street firms doing to prevent this type of thing from happening again, if they can do anything?
Right. So it's a really difficult question because it's almost unknown what brokers, at least like Robinhood, can do or at least would want to do. We can put it that way. We know that regulators are looking into what happened last week. There's no doubt about that. And there's some talk about how regulators could be targeting short selling. They could be looking at the options market, possibly a transaction tax. But from the broker side, they're in a difficult position because think about Robinhood. When Robinhood came to market years ago, their clear proposition was that they were a zero-fee trading firm in which anyone could come in and trade for free. And they forced the likes of Charles Schwab, E-Trade, TD Ameritrade, for example, to all follow that model. So when you think about what's going to change what has happened in markets lately, it's taking away or re-adding, I should say, the friction in markets. Larry Tabb, who now works at Bloomberg Intelligence, he's the head of our market structure research, he described it as saying that if you take commissions out of the market and you can trade for free, essentially that makes gambling in the stock market cheaper than gambling in a casino or going to Vegas. So, and you also almost have better odds in the stock market too. So unless there is friction added back to trading in the stock market in the form of a tax or commissions or fees, there's little understanding of why the actions we've seen of late might change down the road.
So what you're saying is in this sort of effort to make, in the words of Robinhood, democratize the stock market and Wall Street and finance for everybody, it's become too easy for traders to do these things?
So it's difficult to put it that way because you would like to say in a perfect world, absolutely, everyone should have equal access to capital markets and be able to invest and build wealth for them in the future. The worry is that when you get to a point where it not overwhelms the system, but changes the system in a way that could be detrimental. You look at what happened with GameStop over the past couple of weeks, and you also have to remember that, sure, the fall that we've seen on GameStop, and you can see it right there, has been staggering over the past couple of days. But year to date, GameStop is still up more than 300%. And I've spoken to retail traders who got in the beginning of January and who still have made a lot of money. So there are always going to be people on both ends of the coin or sitting on both ends of the trade. You have some right now who would argue that What happened? There's nothing wrong with it. They've made plenty of money trading in GameStop because they were early to the party. But at the same time, you have many who got in at the top when GameStop was trading between $400 and $500 a share, who have now been horribly burned and lost money too. And then you also think about the markets at large and just how this has almost changed dynamics within market structure. So it really raises a large question that's hard to answer.
So Sarah, can you talk a little bit about how Robinhood and other no-fee trading apps actually make money using payment for order flow?
Right. So payment for order flow is this practice where brokers like Robinhood, and it's a very common industry practice, it's not just Robinhood, they send their clients' orders to high-frequency traders or market makers, often one and the same. And the reason they do this is because the market makers will then pay the brokers for the trades that they send their way because they make a little bit of money off of the spread on those trades. So the market makers can make money by doing this. It also helps these brokers like Robinhood be able to charge nothing on their trades. It's really how Robinhood was able to do what they do from the start, this payment for order flow model. Now, there are arguments here. Some will argue that this actually helps improve prices that retail traders get. Some, on the other hand, will argue more nefariously that they're front-running trades, that it's not in the best interest of retail traders. Of course, Robinhood and brokers do say they have a fiduciary responsibility and they have to make sure that they are sending the trades to the market maker that is going to get them the best price. So you can go back and forth here, of course, and there are many arguments and debates that have been had and I'm sure will be had in the future on this very topic. However, I do know that headlines have come out over the past couple of days saying that this is something that some government entities and regulators may be looking at here.
Meaning that potentially these businesses would have to change their business model and find another way to provide no-fee trades for their users?
Yes. If payment for order flow was attacked and changed, you would imagine that would certainly force zero-fee commission brokers to have to change their models because they would lose a huge portion of their revenue stream. So they would have to make up for that elsewhere. Still, I would assume, though, and this is just an assumption, that you are going to have lawyers and many from these no-fee brokers like Robinhood who are going to come and try to preach about what payment for order flow does, what the upside is to it, and try to make sure that that isn't taken away.
Markets reporter Sarah Ponsick. Sarah, thank you as always for your time. Great to see you this morning.